In this module, we'll begin by discussing Schedule E. Schedule E covers the reporting of rental income and the income received from Schedule K1. So what is a K1 exactly? Well, a K1 reports a taxpayer's share of income and other distributions, deductions, and credits from partnerships, S corporations, and some estates and trusts. And you notice partnerships, the main form for a partnership or a partnership income tax form is a 1065. An S corporation is reported on an 1120S, and estates and trusts are reported on Form 1041. So each of these forms will ultimately generate a K1 for an individual taxpayer. Here's an example of a Schedule K1. This one's from an 1120S. And you notice over in Part 3, the shareholder's share of current year income, deductions, credits, and other items. This is where the ordinary business income and loss is reported, deductions, long-term capital gains, short-term capital gains, and so forth. Now, as we said, Schedule K1s come from partnerships, S corporations, estates, and trust. Now, these entities are also called pass-through entities. In other words, the income passes through the entity to the individual taxpayer. These entities aren't subject to income tax. Rather, the owners are directly taxed individually on the income, taking into account their share of the profits and losses. Now, as we saw from the example that we had on the screen of the K1 just a few moments ago, Schedule K1 income can include interest income, dividend income, net short-term capital gains and losses, net long-term capital gains and losses, tax-exempt interest income, and royalty income. Schedule E is used to report income or loss from these partnerships, S corporations, as well as estates and trusts. Now let's move on to rental income, again reported on Schedule E. The dictionary definition: rental income is any payment that you receive for the use or occupation of property and generally must be included in gross income. In addition to amounts you receive as normal rent payments, there are other amounts that may be considered rental income: payment for canceling a lease, expenses paid by a tenant, advance rent, and you report this advance rent in the year that you receive it. Security deposits. You do not include security deposits in income if you plan to return it at the end of the lease. If you keep it, then of course you would include it in income for that year. If you rent property that you also use as your home and you rent it for fewer than 15 days during the tax year, you do not include the rent that you receive in your income, and you don't get to deduct any rental expenses. We have a little event here in Augusta, Georgia that you may have heard of that occurs annually, and a lot of people here in Augusta rent their houses out for this particular event. These folks don't have to report that rental income, but again, they do not get to deduct their rental expenses. So now let's talk about rental expenses. We want to reduce some of that rental income if we possibly can. You can deduct rental expenses in the year that you pay them. And in regard to vacant rental property, you can deduct ordinary and necessary expenses for maintaining the property while it's vacant. However, you cannot deduct any loss of rental income for the period that the property is vacant. So when can you start claiming expenses for your rental property? Well, from the time that you make it available for rent. And again, uncollected rent, you do not report uncollected rent. Because you don't include it in your income, you can't deduct it. What are some of the more common deductible rental expenses? There's mortgage interest, property taxes, property insurance, auto and travel expenses related to the production of rental income, and the standard mileage rate, 54 cents per mile for 2016. Property repairs. Now, again, you can deduct the cost of repairs to your rental property, but you cannot deduct the cost of improvements. We recover the cost of these improvements, these capital improvements, by taking depreciation. Repairs keep your property in good operating condition. They don't materially add to the value of the property or substantially prolong its life. Improvements, however, add to the value of the property. They prolong its life, or they might adapt the property to new uses. Some examples: adding a rec room, adding a bath or bedroom, putting up a fence, putting on a new roof, new cabinets, paving a driveway. These are all examples of improvements, not repairs. Some other expenses that we can deduct from rental income: advertising, cleaning and maintenance services, utilities, and commissions for the collection of rent. Now again, we mentioned depreciation just a moment ago. Let's talk some more about this. You recover your cost in income-producing property through yearly tax deductions. You do this by depreciating the property. That is, by deducting some of your cost on your tax return each year. Generally, we use Form 4562 to figure, calculate, and report depreciation on our rental property. Three basic factors determine how much depreciation we can deduct: basis in the property, the recovery period, in other words, how long you're able to depreciate the property, and what's called a depreciation method. So what are some examples of depreciable property? Well, there's buildings, machinery, furniture, vehicles, and improvements made to rental property. Now, we spoke about depreciation methods just a moment ago. One of the depreciation methods is called MACRS, M-A-C-R-S, or the Modified Accelerated Cost Recovery System. There's also ACRS, or Accelerated Cost Recovery System, and ACRS covers property placed in service after 1980 but before 1987. And there's straight-line depreciation. Most businesses and investment property owners that have placed their property in service after 1986, they use the depreciation method MACRS. And like we said earlier, to calculate your MACRS deduction, we need to know the recovery period, the placed in service date, and a depreciable basis. So what are recovery periods? Well, below are some examples of recovery periods. And again, a recovery period is how many years the item can be depreciated. And this is for property used in rental activities: computers, 5 years; automobiles, 5 years; appliances, 5 years; furniture, 5 years; shrubbery and fences, 15 years; residential rental property, the building itself, 27.5 years; and any additions and improvements such as a new roof, 27.5 years, the same recovery period as that of the property to which the addition or the improvement is made. The placed in service date. You can begin to depreciate property when you place it in service in order to produce income. Rental property is considered placed in service when it's ready and available for use. The depreciable basis. The basis used for calculating depreciation is your original basis in the property increased by any additions or improvements. Your original basis is usually your cost. But you have to keep in mind, you must subtract the value of the land before arriving at the basis for a rental house. A rule of thumb for the value of a lot is 10% of the total value of the home. Land is not a depreciable asset. For example, a home purchased for $200,000 would have a depreciable basis of $180,000. We calculate depreciation expense by using depreciation tables that are given to us by the IRS. If you're using tax software, of course, these depreciation tables are automatically built into the software that you're using. For example, Maker's 5-year property, using the half-year convention, if we put the asset in service in the first year, we get 20% depreciation, 20% of the basis we get to take in depreciation. Maker's 7-year property, using the half-year convention, if we put the asset in service the first year, we get 14.29% of the basis to use as depreciation. Now, just a little sidebar on depreciation. We just mentioned the half-year convention. For most depreciable property, other than real estate, a half-year convention has to be used. This means that no matter what month of the year that you begin using the property, you must treat it as if you began its use in the middle of the year. So you'll generally get 1/2 of the first year's depreciation regardless of when you placed the property in service. The mid-quarter convention involves this. There's an exception to this half-year convention. If Uncle Sam were going to give you a half-year's tax break for a purchase that's made any time during the year, then what's going to keep you from routinely purchasing all of your business assets and placing them in use in the final days of December? Well, that would allow you to get a deduction for a half-year's worth of depreciation while avoiding any actual cash outlay until later in the year. Good deal? You bet. But unfortunately, the IRS is well aware of this strategy, and they've imposed the mid-quarter convention rules to prevent you from doing just that. These rules, again called the mid-quarter convention rules, apply if you place more than 40% of your total new property for the year into service in the last quarter. More than 40% in the last quarter. If you do, you'll have to use these rules for all of your assets placed in service during the year. Under the mid-quarter rules, assets are considered to be placed in service at the midpoint of the quarter in which they were actually placed in service. Now, again, going back to our depreciation tables, let's look at an example. Harley Drew purchased a rental house on January the 10th, 2015. The house was in great shape, was ready to rent the next day. After subtracting the value of the land, the cost basis of the house was determined to be $160,000. So how much depreciation is Mr. Drew able to subtract from his rental income on his 2016 tax return? Well, we're looking at the second year. He placed the house in service in January, and we come up with a percentage from the table of 3.636%. So $160,000, the basis of the house, times 3.636% equals $5,818. That's the amount of depreciation that he'll be able to subtract from his rental income. He also purchased a side-by-side refrigerator from Home Depot for $1,200 on the 12th of January, 2015, for use in this same rental house. So how much depreciation can he deduct because of the refrigerator purchase? Well, again, we're in the second year, using the half-year convention, 32%. So $1,200, the basis in the refrigerator, times 32% equals $384. Now, he rented the home to a college professor for the entire year of 2016. And because he's such a nice guy, he only charged her $1,200 a month rent. If Mr. Drew has no other expenses associated with this rental property, then how much income does he have to report on his Schedule E and eventually on his 1040 for the year 2016 from this piece of rental property? Well, let's take a look. Total amount of rent received for the year, $1,200 times 12 months, $14,400. We looked at the depreciation. We calculated the depreciation from the house itself, and that was $5,818. We calculated $384 in depreciation for the refrigerator. So the total amount of rental income that he needs to report on his Schedule E and on his 1040, $8,198. So as we said, depreciation is typically reported on Form 4562. And here's the Form 4562 for Harley Drew's tax return, reporting the $6,202 in total depreciation that he gets to claim for his rental property. Here's his Schedule E, reporting his rental income and his expenses for the rental property. Now, of course, there would be more rental expenses involved if this were a true scenario, but in this particular case, we're just talking about depreciation. So the depreciation is listed there on line 18, the depreciation expense, the total income that Mr. Drew has to report on his 1040, on line 24 there on the Schedule E, $8,198. And this amount transfers to line 17 on the 1040. Now, what if you have losses on your rental property? What if your expenses exceed your rental income? Well, renting out your real estate property is generally considered a passive activity, even if you devote a substantial amount of time in selecting the right tenants, repairing the rental unit, and inspecting the property for routine maintenance. What this means is that the IRS is going to limit your losses from your rental property, your rental business, to a maximum of $25,000 per year. Again, this is $25,000 in total losses from all of your rental properties. For example, Buzz Aldrin is retired, but in his spare time, he maintains 5 rental homes. He rented each house for $1,000 per month. He was fortunate enough to keep them all rented all year long, so his total income from all of the rental properties was $60,000. However, when he subtracted his expenses, repairs, and depreciation on all of his properties, he showed a $28,200 loss on his tax return. He's only allowed to subtract, however, $25,000 of the total $28,200 loss this year, and he'll get to carry over the extra $3,200 to next year's tax return. So in Buzz Aldrin's case, he has a rental loss carryover, and rental loss carryovers are shown on Form 8582. Form 8582 limits the rental losses to $25,000. The 8582 also shows the rental losses that will carry forward to next year's tax return, and it shows up on Worksheet 6 in column B as an unallowed loss. So now let's talk about the magical disappearing deduction. Income level limits. The income level limits work something like this. If your modified adjusted gross income, or your MAGI, we're not talking about the 3 gentlemen at Christmas time, is less than $100,000, you can deduct up to $25,000 in passive rental losses against what's called non-passive income. If your modified adjusted gross income is over $100,000, your maximum loss available decreases by 50 cents for every dollar over $100,000. The maximum loss is completely phased out at an income level, a modified adjusted gross income level of $150,000. So, what happens if Mr. Aldrin made $150,000 in Box 1, his wages, on his 2016 W-2? How's that going to affect his rental property loss that we've calculated on his 1040? Well, here's the Form 8582, shows an unallowed loss of $28,200 that will have to be carried forward. His 1040 looks something like this. And because of his higher income, Mr. Aldrin can't show any loss at all. No rental losses at all on his 2016 tax return. The loss will be carried over to his 2017 return. He'll be able to take it there if his income will allow. In summary, a Schedule K-1 is used to report income and deductions from an S corporation, a partnership, or an estate. The K-1 is then reported on Schedule E. S corporations, partnerships, and estates are sometimes referred to as pass-through entities. Income passes through each entity and then is distributed to the individual taxpayers. Income and deductions from rental property are also reported on Schedule E. If you rent your home for fewer than 15 days, you do not report the income or the expenses. Recover the cost of improvements to rental property by taking a depreciation deduction. The IRS limits losses from rental property to a maximum of $25,000 per year. And finally, unallowed rental losses are shown on Form 8582 and are carried forward to the next year's tax return. Now let's look at some review questions.